In early July, the U.S. Treasury yield curve, measured in 2-year versus 10-year, traded at an over 40-year low of negative 108 basis points. Now, at the time, the narrative was that the Federal Reserve was going to have to remain vigilant in maintaining higher rates in the short end, while the long end, which is more influenced by non-Fed market forces, was telling us that inflation was not going to be as big a problem in the future. Now, that story's changed dramatically. Now the 2s versus 10 spread sits at approximately negative 35 basis points. Now, the majority of the movement in the spread, though, has been the 10-year, as the Fed continues to assure the market that they are very close to the end of their tightening cycle. The 10-year, however, has screamed higher in the time period from 3.8% in early July to 4.8% now. Oddly, only part of that move seems to be about inflation worries. The other part of the move appears to be a market conviction that the federal government may be increasing spending and increasing the bond issuance that would accompany it. Now, this notion gained some more steam as concerns over military aid packages to Israel surfaced. Now, an increasing supply of long-end bonds could push prices lower and yields higher in that part of the curve. Now, the latest news of a hotter-than-expected retail sales number does have the potential to push the Fed into another short-end hike, although the probability currently sits at 40% by the December meeting. Now, if the Fed does hike in the short end, the potential may be for the market to adjust long-end rates lower to counterbalance the potential for a possible Fed overcorrection, which could cause economic stress. Now, if a trader believes that higher-end yields could continue higher faster than short-end, normalizing the yield curve, they could express that by buying the October micro 2-year versus 10-year Treasury yield futures contract at negative 32 and targeting a move back to zero. A stop for this trade could be placed below at negative 55. Now, this trade could make $320 if the target is reached and risks $230 if you're stopped at your level. Now, if a trader believes that the yield curve could invert further from here, they could express that by selling that October micro 2-year versus 10-year Treasury yield futures contract at negative 32 and targeting a move to the September lows of negative 75. Now, a stop for this trade could be placed above at positive 10. This trade could make $430 if the target is reached and risks $420 if you're stopped out of your level.